All right, welcome back to Investing Wizards 2022 edition. It is my pleasure to have Ross Yarrow, Managing Director of Sales at Baird, who has an interesting walkthrough about some thematic trends, and I'm super excited to talk to you, Ross.
It's great to be back on. Thank you very much for having me. How are things in sunny Miami?
Sunny Miami, great. The sunshine is consistent, and it was my first New Year's Christmas in Miami, so cannot complain.
Very good. Well, the cold is very consistent in London, so at least we're consistent with the consistency.
There you go. Consistency is a plus. You're kind of our second. This is your second time in Investing Wizards, and we had a lot of positive feedback after your last appearance, and wanted to bring you back to really discuss some of the key themes that you've been discussing with clients, and kind of talk to us about what's top of mind.
Great. Well, what I thought would be good to do is maybe just to start by going over what happened in 2021, because 2020 and 2021 were kind of wild years. And I think it's useful to see where we've come from to work out where we might be going. And then we'll dive into some of the thematics and areas of this year. And also, I'm not allowed to talk about single stocks, sadly, but I am allowed to talk about the stock selection method. And so I'd love to spend a bit of time discussing that as well, if that's okay.
Absolutely. That sounds great.
Cool. Well, let me share my screen. So 2021 was a reverse in a lot of ways to what happened in 2020. This chart here shows that in 2020, huge multiple expansion in red that more than outweighed the negative EPS growth we had for the market. In 21, it was completely flipped around. And we actually had multiple compression. The market got cheaper as it went up because this huge earnings growth more than outweighed it. And earnings growth is continuing. And unlike most years where earnings estimates start very high as analysts are too optimistic and then slowly the dawn of reality sinks in, earnings estimates for 22 continue to be positive. And that's actually the first time we've seen that happen in over a decade. Now, 2021 was a very painful year for active managers. 79% of active fund managers underperformed the benchmark. That's the worst since 2014. And it wasn't just the number that were underperforming, it was actually the degree to which they underperformed, which was very painful. 37% underperformed by more than 10%. So we've got a huge tail here on the left side of that performance distribution. If you look at 2020 and 2021 combined, that actually leaves a very small and very impressive group of just 5.4% of funds who managed to outperform in both periods. So either period in its own right was difficult to outperform in, but combining the two periods together, as you can see from this, was almost impossible to do.
So, Ross, these are global funds. And when you say funds, are they mutual funds or hedge funds?
So the screen here was anything with an MSCI World or All Country World Index as an active fund. So that's a combination of mutual funds and hedge funds mainly.
Got it. Interesting. So that begs the question of why was it so hard to outperform in 2020 and 2021?
Yeah, no, it's a good question. So in 2020, the factor performance was very straightforward. It wasn't good if you were on the wrong side of it, but growth, high quality, and high valuation outperformed low growth, low quality, and low valuation by about 30 to 40 percentage points. And so if you're on the right side of that, it was happy days. If you're on the wrong, it was very painful. 2021, it was more of a mixed bag. And by mixed bag, I mean the factors were all over the place. So some of the best factors include high PS growth, so it looks like growth's winning, but then also low PE. You've got high quality, you've got low quality. You had this very bizarre section of winners. What I find most interesting about the factor performance for 21 is right at the bottom. The single worst performing factor was actually low weighted average cost of capital. And that underperformed by about 9 percentage points. So a huge degree of underperformance. And the reason for that, I think, is there are two types of stocks that did really well last year. There were the really cyclical companies, the ones that almost went bankrupt in 2020 but didn't. Airlines, banks, a lot of oil companies, casinos, they had a huge rebound this year. And then on the other side of the barbell has been the very strong growth companies, the Teslas of the world, the Nvidias of the world. And neither of those two categories has a particularly low cost of capital. And so what that is leaving in the middle is this low WACC cohort, which is actually very owned by institutional funds.
Got it. So it's like a little bit it's a little bit counterintuitive that you would think that low weighted average cost of capital companies would just do well. And last year was this kind of like year where those were particularly the ones that underperformed. Was that relegated? Was that because of a particular sector exposure for that sort of factor?
No, it's actually quite broad sector exposure in there. I think it's literally just that the kind of stocks the market was buying was they wanted super growth or super cyclical, and it was those more stable, more boring names in the middle that were left behind. I mean, looking at a few of those names in particular, these 5 stocks, they accounted for 9 percentage points of performance last year. So if you didn't own those 5 stocks, that's a third of the market performance that you've got to find elsewhere. Now, that's not as concentrated as in 2020, where it was almost 13 percentage points, but by historic standards, it's still pretty concentrated. Now, one stock in particular, I think was very painful for active fund managers, and that is Tesla, because its inclusion in the S&P 500, it cost you 84 basis points if you didn't own it last year. And not nobody, but very few people own Tesla, at least as a proportion of how big it is for the market. So Tesla, just over $1 trillion market cap, you would expect it to be owned in the top 10 holdings of around about a quarter of active funds. This is global funds. The reality is, sorry, this is US funds. The reality is it is owned in just 4% of funds. So that one stock cost people a huge amount of alpha in 2021.
Wow. And sort of like at least the announcement over the Christmas holidays in terms of their production and the jump on the first day of trading sounds like it's going to be, it is more pain year to date in the first couple of trading days for the fund managers that continue to underweight it.
That's right, and it's been a painful start to the year actually for a lot of fund managers already. Bond yields have risen quite a lot. We've had quite a strong cyclical rebound, and so for those who've been growth positioned, 2022 has not been off for a good start.
And so if we talk about like the process, how your clients or how Wall Street portfolio managers think about managing the portfolio. It's really hard to sort of flip your outlook and to flip the way that a portfolio manager invests, so that a lot of the managers, like that scatter plot that you showed, the top right quadrant, basically a portfolio manager had to own a certain type of stock in 2020, which was maybe more the sassy stock or the high growth stock, and had to shift to a more value weighting in 2021 and basically change their mindset. And like how, from a portfolio manager standpoint, how do your clients think about that from like kind of totally shifting their outlook and their concentration to own more value names, because that's that's kind of like what aligns with the current cycle?
It's a great question. It's very difficult to do. I mean, from a psychological point of view, confirmation bias makes it really hard for anyone to change their minds about any kind of ideology. So that's the first thing that makes that difficult. Secondly, fund managers, they find themselves in echo chambers, not just of their colleagues, but also of their clients. So if you're running a growth fund or if you're running a value fund, it's very difficult for you to suddenly say, well, actually, you know what, I think we should do the opposite of what our stated aim is this year. And often you wouldn't even be allowed to. Clients would either not tolerate it, or you have specific screening criteria for valuation or growth or return metrics that you have to have in order for a stock to be in your total addressable universe.
Yeah, it's and just looking at this contribution chart, I find it so fascinating because if I just sort of think about last year, where a lot of there's been a lot of pain and a lot of weakness in high growth names, particularly in the software space and the SaaS space. You wouldn't expect to see Nvidia and Tesla on here, just knowing what their multiples are and what the growth rates are. You could argue that Microsoft, Google, and Apple are a little bit more GARPy. They're maybe expensive or high growth, but they're not Nvidia or Tesla expensive. But having these two stocks as kind of like the top performers and going against that thread of high growth names being sold off, I guess it really mattered kind of what high growth sector you didn't own or what high growth sector you did own, because in the automotive space, in the chip space, high growth actually did well, which is just not easy to think about and not easy to predict.
Yeah, I mean, I guess there's two elements to it. There's the overall value growth dynamics, which, as we'll discuss in a bit, are predominantly driven by what happens in the yield curve and what bond yields do. And that moves the relative performance of those buckets. But then you've got the individual stock performances and things that happen that even if their bucket goes up, if they've done particularly badly, can drop way out the bottom, or if their bucket's done badly and they've performed outrageously well, can fly out the top. So there's kind of a lot of the time there's competing forces on those metrics.
Interesting.
Now, for 2022, a few things I thought would be good to talk about. Firstly, are we going to be in a continued bull market? Will we get strong jobs growth that has the potential to drive us higher? The US versus Europe is always a very contentious point of conversation. I think oil has been an incredible roller coaster ride. There's quite a few interesting things going on there this year. Inflation, probably the biggest risk people are talking about in the market. Is that transitory or is it here to stay? What are its implications in the bond market? And then maybe we'll chat about the housing market and a few risks as well. But firstly, for the overall market, this is one of my favorite charts. The easy money has been made because people have been saying almost every month since coming out of the financial crisis that the easy money has been made. And it turns out what matters is not what the market has done. In fact, if you look at the correlation between what the market does in 1 year and what it does in the next, it is essentially zero. What matters is what employment does. And if employment rises, that is the blue line going up, green shaded area, it's very, very rare that the market peaks for the cycle. Now, we've recovered a huge amount of employment since the trough of the pandemic, but we are still about 4 million people short of where we were back here. So there's a lot of employment growth potential left. And if you look at what the market's done when we've seen this kind of job creation in the past, it's been rather spectacular. So look what happened from here, from 2010 to 2020. Big move in equity, big move in employment. Mm-hmm. Equities tripled. And by the way, they were already up 60% from their trough by that point. They then more than tripled. And so we're not in a very dissimilar position today than what we were back there. Or same thing here, big move in jobs, big move in equities, huge move in jobs, huge move in equities. Now, the pushback that I get every day is valuation. Mm-hmm. Well, here's the performance of the market versus its valuation at the start of each year. It's just a complete random spray gun approach. I think we discussed last time, even if you look at CAPE and do it on a 10-year view, selection bias has made the 1990s crash and make that chart look like there's a real correlation. If you remove those very small points, the correlation actually gets very low very quickly. Even 2000s, this is a debate that I have, it seems almost on a daily basis with clients. I don't believe that valuation was the reason we collapsed in 2000. Because if it was, what was so special about 22 times forward earnings that made us peak here? Or why didn't we peak in 1999 when we were more expensive? Or why didn't we peak in 1998 when we were as expensive? Or 97 when we were at a 10-year valuation high? What was so special about 2000? Well, it comes straight back to employment. Employment peaked, it rolled over. And as we see almost every time when employment rolls over went the market as well. But we've got a little bit of an employment issue at the moment in the US, actually, and most of the Western world, because every company is telling us that we've got these staff and labor shortages. McDonald's are literally hiring children to serve you burgers. We've got a near record number of job vacancies. And how is that compatible with the fact that there are almost 4 million fewer people working today than there were before the pandemic? It doesn't seem compatible. Well, some of these people, yes, they've retired. Some of them have become crypto millionaires. But actually, I think the more simple explanation for this is that during the pandemic, we quite rightly launched a lot of very generous welfare programs. And we were paying people up to almost $29 an hour not to work. And as the real world has begun to open again, this has caused quite a distortion in the labor market. Because if you have as a rational human being have a choice between $29 an hour to not work or $15 an hour to stack shelves, I mean, it's not a difficult choice to make. Now, this all changed on September the 6th, when the $300 per week COVID supplement to unemployment benefits was axed across all states. So in September the 6th, we had this $300 cut. That works out about $8 an hour, by the way. Look what happened to continuing jobless claims the following month. October saw the biggest drop in continuing claims we've seen all year, 19%. In fact, the only other drop that comes close was in July. It was 14%. That was after the first round of cuts to federal jobless claims. So that's one part of the equation for job creation. The second part, which is very positive, is for the first time in a long time, we're seeing people at the low end of the wage spectrum get the highest wage growth year over year. And the people at the high end are seeing the lowest. Now, for as long as I can remember, this chart has been the other way around, with the richest in society getting the biggest annual increases in pay and the poorest in society getting the lowest. And this is really positive for 4 reasons. Firstly, just from a social good point of view, it allows these people to meet their families' needs. It helps address some of the equality issues. That's firstly. Secondly, from a public finances point of view, less income support needed at the low end is good for public finances. Consumption, when these people up here making 6 figures, when they get paid a bit more, they usually pay down debt or they will invest their money. When people at the low end of the wage spectrum get more money, they spend it. It goes straight back into the real economy with a multiplier effect. And then fourthly, and most importantly, having lower wages at the starting end, at the low end, that is helping bring people back into the workforce who are on the sidelines. And if you're on the sidelines thinking, can I afford to get a job? Well, suddenly that math changed on the unemployment benefit side, but now it's changed on the job side, because now your starting salary in leisure and hospitality, say, is no longer $15 like it was quite recently. Now it's going to be $18. And I think if employment is the single most important determinant of market direction, having things that help extend this job creation over the next few months and years is a really good thing for those people getting jobs, but also for equities.
That's interesting. That's a pretty solid kind of way to think about solid thesis. Is like, hey, jobs is the thing that matters. Here's the way to think about jobs continuing, and here are the arguments on why the trend can continue for much longer, and that sort of underpins the longer bull market. And I really like your point of valuation. I think people automatically, they have this kind of tendency to just very flippantly be like, hey, valuation's high, so that's a good reason not to be bullish on equities, where in reality, one, valuation doesn't matter all that much, and two is it's not that elevated. It is elevated, but it's not extreme. So if you're kind of gonna poo-poo equities just based on the fact that it's elevated or it's higher than average, like that's not historically, that hasn't been a good reason not to be bullish on equities.
Absolutely. And if you were angry with the equities market at the start of last year because it was too expensive, Can you imagine how angry you'd be now that it's up 28% and it's got cheaper during that time period?
That's right. So I think it's interesting because you showed here on the PE is a trailing 12 months. I guess showing it as a forward 12 months, where we would be much lower. Obviously, the other years would be lower as well because the forward multiple is typically lower. But because we've had such high EPS growth, that like the market has anticipated that EPS growth, and the multiple would compensate for that.
Yeah, absolutely. I think the other thing which is quite widely misunderstood is what is a good year in equities. Now, we know 2021 was a good year. The base that most people tend to compare it to is the equity markets long term, they compound at 6 to 8% total return.
Right.
And so whenever we have a up 10% year, people think, oh, well, that's big. Up 12, well, that's big. Well, the reality is the compounding is actually only so low because it takes into account all the negative years. For positive years alone, the median and average return of equities is 16 and 17%. So yes, last year was a very big year, but far from a blowout year when you actually look at what do the average up years do. It's much higher than most people think.
That's interesting. I've actually never heard. I've never thought about it that way, which makes total sense in terms of if you think about the return for the past 100 years since 1920, which is I think where the S&P series starts. It's about 7% a year or 8% a year total return. But if you take out the negative years, then it's much higher. So a double-digit positive year is actually just right in line.
It's fairly normal, absolutely. Now, the other area where valuation really doesn't matter is when comparing markets. So the US versus Europe has always been a sore point because the US has been at a premium for a very long time. Right now, we're at about 50% PE premium to Europe. And the devastating thing for followers of this relative PE is there's precisely zero predictive power that it has. I mean, the US got expensive here and outperformed. It got expensive here, outperformed. It got cheap here and then underperformed. I mean, it's not a useless indicator. It's a worse than useless indicator. What matters isn't relative valuation, it's relative revenue growth. And if the US grows revenue faster than the rest of the world, or faster than Europe, it outperforms. If it grows revenue slower, that's the green line going down, it underperforms. It's a very, very, very strong correlation. And on consensus, and consensus can always be wrong, but on consensus for next year, the US is growing revenue at 7%. The median company is 7%. And that's higher than basically every major European country, apart from Denmark and Ireland. So if history is our guide, and if this is right, the US could be in for another good year. And I think the US has now outperformed Europe 9 of the last 11 years. This was the sixth consecutive year that the US has outperformed Europe in, despite its premium valuation. And the reason valuation doesn't matter in this case is because the sector composition explains the entire difference. The US has loads of tech, loads of comm services, whereas Europe has hardly got any of those, but Europe's got loads of industrials, financials, materials. It's got the cheaper, more cyclical sectors. If you actually compare apples to apples, Europe is more expensive in consumer discretionary, technology, industrials, healthcare, and staples. So far from the US being at a premium to Europe, if you adjust sector weights accordingly, Europe is actually at a premium to the US rather than the other way around.
Interesting. Yeah, those sector weights really do matter.
Makes a huge difference. Now, oil, I think, is really, really interesting because we've had a negative $47 oil. I mean, I don't think many people entering 2020 thought that we'd have a negative oil price. Then we've run up to 80 this year. We've come down a little bit. The really fascinating thing about oil is it only takes a teeny difference between supply and demand to make a massive difference in price. Actually, this is the same for most commodities, but for oil in particular. So look what happened back in 2014. Oil supply globally in green was about 2% above oil demand in red. 2%. The price of oil dropped 75%. Absolutely crushed. Fast forward to today, Oil supply in green is about 2% below oil demand in red. And oil has been rising, albeit with some volatility, fairly steadily over the last year or so. Now, normally when the price of oil rises, you get a kind of corresponding rise in the rig counts of people drilling new oil wells. But look what's happening right now. The price of oil has ripped, but the rig count is actually still pretty depressed. And the reason for this, or I think the reason for this, is rightly or wrongly, Western governments have been making it very difficult to drill new oil wells. Companies have, again, rightly or wrongly, being out of choice or shareholder pressure, reducing the number of new oil wells that they are drilling. But as a result, we found ourselves in what could end up being quite a sticky situation. There are two elements to getting oil out the ground. There's the drilling phase, where you drill a mile down and then a mile in every direction. And that might cost you $5 million. That's the difficult bit. And then there's the completion phase, where you seal everything in concrete, you pump water and sand down at huge pressure to fracture the rock, and you prepare that well for extraction. At the moment, the number of new oil wells that have been drilled in red is not keeping up with the number of oil wells that are being completed. And so the number of drilled but uncompleted wells is absolutely collapsing. And this is where your marginal supply is. This is where we go if we need more oil quickly and affordably. You find an oil well that has been drilled but not completed, you complete it, you start production. And unless we see a jump in new drilling in the next few months, or unless OPEC really decides to help out with supply, we could find ourselves in a really tight situation at some point in the next few months.
Yeah, this is such an interesting dynamic, because I think that, like, throughout my career, I've had sort of like two phases in oil. The first phase was in the kind of 2002 to 2008 period, with the super spike and just oil going to infinity. And oil was the new gold and emerging market demand. And then sort of like that in-between period, and then 2012, just oil couldn't go any lower, and then obviously went negative. And you're in this kind of new paradigm where prices are going up, which is different than what's happened over the past 10 years. But you have this new dynamic that you mentioned, with companies drilling less wells and not reacting to the oil price being so high, because they have been, one, so scarred by this period over the past 10 years, with so many energy companies went out of business. So they're more conservative. And two, you mentioned kind of this whole new emerging powerful concept of climate change, and companies reacting to that, and also lenders reacting to that. So now there's the cost of capital is just much higher for these energy companies to do these wells, because there are fewer firms that are willing to lend it, which perversely causes oil prices to go up. And so you're in kind of this tough spot based on all these things, where, as you kind of point out and paint the thesis, that oil prices can continue to go up because supply just isn't going to catch up to demand.
Yeah, absolutely. I mean, ironically, the environmental movement could be the best thing that ever happened to oil companies.
Right.
If they end up selling a lot more oil and not having to drill new wells, it's happy days. In the same way, or I guess the opposite way, to fracking in, I guess, 2012, 13, 14, when that new technology was really making huge leaps and bounds, and oil companies were getting so excited, saying, we're going to be able to get so much more oil out the ground with this new technology, which they did. And then, of course, supply and demand go completely away from each other, and the oil price collapses. So what is good or bad on the surface for an industry is not always the reality that we observe.
Right. Interesting.
Now, having said that on oil, I do remain in the inflation is transitory camp. Oil has been by far the biggest contributor to the move that we've seen in CPI. It has a very interesting relationship with inflation. Look what happened back in 2012. The price of oil, 2011, the price of oil absolutely ripped to over $100 in red here. CPI in white had a corresponding big move. Then something really interesting happens. Oil stays at $100 for 3 whole years and CPI drops below 2%. Because the inflationary impact that the oil price has is in the change of oil price rather than just having a high oil price per se. And we've been through that. We've been through our big move from big negative to big positive oil price. Now, if oil stays where it is, there's some very interesting mathematical things that happen. So these are the contributing components to CPI. Energy is in green, and that, as you can see, has gone from a big negative contributor to overall CPI to a very strong positive. Now, the way that inflation maths works, if the price of something goes from 100 to 107, you end up with 7% inflation for a full 12-month period, because it's just new price divided by the same price 12 months ago. If oil stays where it is, these green bars will stay a very similar size until about the summer. And then the base effect kicks in. And those green bars, they vanish. And that immediately takes, just from the top line, that takes about 2 percentage points off inflation. Now, that's just off the direct energy price. What about its input into food and goods? And services to a lesser extent, but food and goods. I mean, maybe another 100 basis points. And so if that's the case, then you could be back to 3%-ish CPI by the summer. And this is happening at the same time that a lot of other bottlenecks are getting sorted. Iron ore, we had a big tight supply. Now the price of iron ore has collapsed. Timber has had an interesting ride. The price of lumber ripped and we heard lots about it. Then it actually collapsed. We heard nothing about the collapse. Now it's bounced a bit in the last couple of months, but still not back to where it was. Semis, they might not get those bottlenecks sorted until the second half of the year, but slowly by surely, all of these bottlenecks are being sorted. Now, the big where could I be wrong here is on those 4 million workers. Because if those 4 million workers don't come back to work, then wage growth gets out of control. Now, wage growth has had quite a big jump driven by the low end, as we discussed. I think that will continue to bring people back into the workforce. But if it doesn't, unlike oil, wage growth seeps into every element of the economy, but has positive rather than negative feedback loops. So the price of goods and services goes up. You then have to pay people more to produce those goods and services. Then the price of goods and services goes up and it spirals and it spirals. So if this thesis is wrong of those people coming back to work, then my inflation transitory thesis is wrong, but also my bond yields low for longer thesis is wrong. And if that happens, these are the subsector correlations of their relative performance to the 10-year yield. So if inflation is wrong and bond yields are wrong and bond yields rise, then you would want to be owning things in the green at the top of the high positive correlation, airlines, banks, energy, insurance, and avoiding things with the strongest negative correlation. That's mainly tech and healthcare, in particular life sciences, pharma, and software. Now, that is by no means my base case, but I think it's very useful to have the, if I'm wrong, what would happen and what is the most likely reason for me being wrong about a particular thesis.
Yeah. And is there any sense of like who, like we talked about kind of the unemployment benefits being very high and incentivizing people to stay. Is there like, have you done any digging into what types of people are working less? Is it kind of like older people like retiring early? Is it like what one end of the spectrum? Like where do those lie?
Yeah, and that's a great question. If you break down the participation rate of the workforce, which the BLS they give you by, I think it's in 6 different cohorts, that 55 plus cohort has seen the lowest recovery in the participation rate. So, I mean, without a doubt, that is showing that there are some people who are choosing not to go back to work because maybe they're approaching retirement and their pension fund, if it was all in US equities, is suddenly looking a lot stronger than it was before. And they might say, you know what, I'm just going to 3 years early, I'll retire. It's not a huge number of people though. I mean, I'd be surprised if that explains even a fifth of this gap that we've got going on here. But going back to bonds, The low for longer thesis is really premised on three things. Firstly, the Fed are tapering, and the Fed will end QE at some point in the next few months. But the Fed and central banks globally are still in control. I think consensus is for 3 rate hikes this year. That is not a huge amount in the grand scheme of things. And if you look at central banks globally, the Fed is actually at the low end for how much it's expanded its balance sheet. So the Federal Reserve's balance sheet is at 38% of GDP. That is lower than the Bank of England. It's almost half the ECB. It's less than a third of the Bank of Japan on its own separate axis. So there is a lot of firepower that central banks globally can still utilize if they need to. Secondly is historical precedents when recessions end, because more often than not, when a recession ends, bond yields fall. Recession ended, they fell here, they fell here, they fell here, here, and here. And it was only in the 80s, when we had much higher levels of inflation, that we saw bond yields rise. And then my favorite one, and this is just mind-blowingly counterintuitive, and I don't really know why, which is annoying, but in each of the last 3 times that the Fed has ended QE programs, bond yields have fallen. QE1 finished, bond yields fell. QE2 finished, bond yields fell. QE3 taper began, bond yields fell, and then QE3 ended, bond yields fell. And so I know this is only a sample size of 3, but I definitely wouldn't want to bet against it. I wouldn't be betting the farm on it, but I think there's strong enough historical precedent here to say, I don't want to be making big bets on bond yields rising. And it feels just now like a lot of people in the world of equities are doing just that and making big bets on bond yields rising.
So I think we talked about this last time in terms of like why this dynamic happens. And I think it's pretty counterintuitive, because the thing you're trying to measure, which is the bond yield, is separate from what the Fed is doing, which is stimulus. And they are obviously related, because the way the Fed is injecting the stimulus is buying bonds or selling bonds. But if you kind of separate those two and think about, is the Fed stimulating the economy or slowing down the economy or withdrawing that stimulus, is kind of like one question. And the question is, how does that impact bond yields, which is a separate question. And like, if you just assume for a moment that the Fed's not buying bonds, they're doing something else, they're dropping money out of a helicopter, then this dynamic would make total sense, right? That when the Fed is printing money and dropping out of the helicopter, yields are going up because it's stimulative. When the Fed is stopping that action or tapering, then that's less stimulative, and bond yields should go down. Bond yields being a proxy of future nominal GDP growth. And I think where the confusion is, well, the Fed's actually buying bonds or selling bonds. So that should have a direct impact. That should have an impact on the price of bonds, but it doesn't, because the Fed is not a monopoly. The Fed does not control the price of bonds. It is just one participant. It's also not an overwhelming participant. It's 20 or 30% of the bond purchase or whatever it is, but that's not enough to set the price of the bonds. That's enough to participate in the bond market because it is so liquid, but it's not enough to actually set the price of bonds. And I think that's where the counterintuitive or the opposite effect happens. And as you point out, it's very consistent. And if you separate those two things and you just think, is the Fed stimulating or not stimulating, then it's a much easier combination or much easier relationship to think about than, well, the Fed is actually doing it and implementing it in the bond market, which makes it a little bit more confusing.
Yeah, no, 100% with that. I think the other very counterintuitive thing is the Fed's impact on inflation, because the kind of generally accepted knowledge is that if the Fed lower rates and they push bond yields down, then that's very stimulative, because your cost of borrowing goes down. So you go and buy another car, you buy another house, you go and spend money. It's all happy days, and that is all else equal inflationary. Well, that's not always the reality, because there's two sides to that coin. If the cost of your borrowing goes down, which helps contribute to consumption and the demand of goods, the cost of capital to the suppliers of those goods has also gone down. And when that happens, it might make sense for that company to go and build another factory, to go and ramp up production, to hire a bunch more people, that increases supply and increases production. And to what extent that outweighs the increased demand from lower rates is absolutely not a foregone conclusion. So ironically, you can see lower rates having a deflationary impact sometimes if it stimulates the supply side of the equation more than it stimulates the demand side of the equation.
I think that's such a great point in that, the economy is so complex because it's an open system, and every positive is a negative somewhere else, like almost by definition. So somebody's revenue is another person or another company's cost. So there's always kind of this balancing act. So like inflation is great for energy companies that are making more money, or sorry, the higher price of oil is great for energy companies that are making more money and their employees are spending money in the economy, but that's negative for consumers that now have to spend more money on gasoline.
Yeah.
The wages are rising. That's great. That's more spending, but that's negative for corporate profits where wages are cost, and they actually have lower margins because of that.
Yeah.
And so these kind of like broad assertions of this is good or this is bad, there's always kind of a nuance because it's both. It's a very gray area with a lot of these dynamics, and as long as they're not extreme, the market and the economy sort of balances them out. And that's the great thing about price discovery. The higher the price of something, the more supply that'll come in, the more like these bottlenecks we're having. I'm totally with you that inflation is transitory because the higher the price, the lower the demand, and the more people are going to try and solve this problem, right? So, and there may be things like we discussed in the oil sector that will make it last longer than normal. But if oil goes to $200, there will be more supply. There's no question about it. That
without doubt.
like people are going to start drilling more oil wells. But I think that's such a good point to make in terms of that double-sided coin or that complexity of the system, and not just like having one simple effect.
And I think your example of oil is a really good one. I remember back in, I think this was 2014, when the price of oil, after the fracking technology, the price of oil was collapsing. And the industrials companies were getting super excited because they were saying, oh my goodness, we can bring back manufacturing, our input costs are going down so much. This is just absolutely wonderful. And then we discovered that energy was a pretty big end market for all of these industrial companies. It drove the US industrial sector into a mid-cycle recession almost.
Right.
And it wasn't almost, it was a mid-cycle recession for much of the industrials world. Things are rarely exactly what they seem on the surface in the economy.
Yeah, absolutely.
In fact, the same with Fed hikes. So I bet if you surveyed even professional investors and said, what has the market done over the last X times the Fed has hiked, you'd probably get some negative examples. Well, here's the reality. Big hike cycle. Look what the market did. It ripped. Big hike cycle. Market ripped. Big hike cycle. Market ripped. Big hike cycle. Okay, market flat. Big cycle. Market ripped. It ripped. It was down. So of that 1, 2, 3, 4, 5, 6, 7 of the last cycles we've seen, 5 of them the market was up, and in a big way. 1 of them the market was flat, and only in 1 of them was the market down. And that was, again, in the 80s, where there were a lot of issues going on with inflation and other things.
Yeah, I think this chart is great because it just sort of it gives you such a great perspective. And you're exactly right. I think someone might say, "Oh, Fed hiking is negative for the market," or "That's not a good rate environment to own equities," and that's completely not true or not supported by the evidence. That kind of goes back to that point of the complexity. When the Fed is raising rates, it is because growth is accelerating or growth is very strong. And as long as the Fed is not overextending or not overly aggressively raising rates, then that's okay. And then that goes to the definition of, well, what does overly mean? How do we know when overly happens? And we know overly doesn't happen from zero because typically the Fed has to raise rates several times or some number of times. And what I look at typically as a measure of that is just 2-year yields versus Fed funds rate. Is when the 2-year yield is above Fed funds rate, the market's sort of saying the Fed's going to have to raise rates based on the growth environment. And you can see that if we pull up a platform like Koyfin and you're able to plot 2-year yields versus Fed funds rate, you'll see that reversal at the end of cycles. when the market starts sniffing out the fact that the Fed is still raising rates, but
Yeah.
the implied yield is actually coming down pretty significantly.
And you get that yield curve inversion, and then the party ends quite soon afterwards.
And then you get that yield curve inversion, the party ends soon afterwards. So we've talked about a lot of things. If I can kind of maybe I think you have a couple more things, but if we could kind of wrap it up with maybe like one or two more points, and then I wanted to maybe show some stuff on Koyfin. I know you showed a lot of Bloomberg charts here, but maybe look at some analytics on Koyfin and how you look at that stuff. And yeah, let's do that right now.
So maybe what would be good is I spend most of my days talking to clients about stocks. I can't talk about single stocks, but I can talk to you about the stock selection process, which I think is as important when we're thinking about what to buy. And I did a bit of I like fact checking, as you know, and I did a bit of fact checking. I started this industry in June 2007. And on our graduate program, we were told that low PE was good and high PE was bad. It turns out they lied to us. This is the S&P 500 at the time. PE on the x-axis. This is actually forward rather than trading. That's a mislabel. And then the return since then on the y-axis. And notice the lack of correlation. In particular, notice the lack of a strong negative correlation like we were told we should expect. But the only correlation I can see is that if you want to find bankruptcy candidates, choose the cheapest ones. What they should have said was work out what stocks are going to grow earnings the most over the next 15 years, and you'll get a much better correlation and idea of which of those names are going to do well. And so I did a bit of an exercise trying to work out what are the characteristics we should be looking for in a stock. We've got this enormous investable universe and the kind of right or left swiping world of 2022. What are the characteristics we should be screening for and against? And so I looked to see what stocks had risen more than tenfold since their 2007 peak. So what stocks are more than a 10 bagger? And there were 66 of them. This is for S&P 500 names. Here are some of those names, some of the bigger ones. Not many surprises in here. You'll know most of them. And I look to see what do they have in common? Because if they've had a track record of being a 10 bagger, what were they like at the start, which will help us as an indication for other stocks in the future? And they had a lot in common. Firstly, they had massive revenue growth. The median revenue growth of these guys was 21%.
This is at that point, not prospective. This is already heading into.
That's actually through that period. So from the start of the period to the end of the period, 21% CAGR EPS. So triple the market's EPS growth. They dominated at what they did. Massive market shares, many with literal monopoly or duopoly situations. Many were expensive or loss-making. A lot of them were in tech, consumer, and healthcare, which is why I spend so much of my life there. A lot of them were small. Most of them started expensive and then got more expensive. And then self-intuitively, but psychologically, the most difficult pill to swallow, all of them doubled 3 times and then went up a little bit more before becoming a 10 bagger. And I think we discussed last time how the top of your screen is not necessarily the top of the stock. In the same way that the bottom of your screen is by no means the bottom of the stock. There's a lot of air above and below. And I look to see what stocks are up the most since their IPO day, just for perspective. And here are those names. And some of these moves are nothing short of spectacular. Kansas City Southern is up 303,000%. Microsoft up 246,000%. So forget about avoiding things that have doubled or tripled. If you had an ideological position, and by the way, this wouldn't sound unreasonable. If your position was, I will not buy anything that's already gone up by more than 31,000%, you wouldn't have been able to own any of these stocks. And that would have cost you a hell of a lot of performance if you did. So I think it's a good to have that second reminder of the top of your screen is not the top of a stock. If a stock has already gone up, that doesn't mean it can't keep going up further, and the same on the downside.
I love that because people are so bad at thinking about percentages and numbers and doublings and triplings and exponential. And so this is a great chart of like thinking about the upside. I love I don't know like who said this, but the saying, what do you call a 90% stock? What do you call a stock that's down 90%? And it's a stock that's down 80% and down another 50% after that. And so if you think about kind of like going from 10 to 1, you have to go from 10 to 2 and then go down 50% from 2 to 1.
Absolutely.
So these percentages, I think this is a great point of like thinking about stuff that's run, and the fact that things have run shows their dominance and actually is a great starting point for saying, hey, this thing could run even more because it has proven that dominance.
Absolutely.
Cool. That's super interesting. It's too bad we can't talk about single stocks. If anyone's listening, they're an institutional investor, then you should contact Ross to be your salesperson, and then he can't talk to you about stocks. So this is a great segue into that potential avenue. And then we've been talking for a while. So just you're a power user, a power Bloomberg user, do a lot of really cool analytics. Maybe we could, if I could ask you kind of like on Koyfin, what are the things that you use in addition to your Bloomberg, which kind of has a lot of power, but maybe it'd be interesting for folks to hear kind of like how you use Koyfin.
Absolutely. I mean, as we discussed last time, I've been a Koyfin supporter and user from quite the early days. One of my colleagues introduced me to it. Frankly, I think having Bloomberg and Koyfin together is a really powerful combination, because there's things you can do on Bloomberg that you can't do on Koyfin, and there's things you can do on Koyfin you can't do on Bloomberg. In particular, there's two areas that I use Koyfin for the most, which is just so much easier and quicker than their alternatives on Bloomberg. The first is looking for factor performance. So if you want to see what has value or momentum or high dividend yield or growth or IPOs done, it's just so easy to go and click on and click off and get that graphically for any time period you want and just see those performance and then compare your own portfolio or your own stocks against that. So that's one function.
So, and that's under, if you could, so that's under market dashboards, and there's a market dashboard called factor analysis.
That's right. Good point. Where it lives. And then the other one is, again, Bloomberg does scatter plots, but Koyfin takes scatter plots, I think, to a whole new level. So if you want to very quickly plot to even very obscure things in the market, and this is a very simple one I did as an example. What was the 2020% performance versus the 2021% performance? Very easy, very quick way to suddenly get a good view of the market. What did losers from 2020 do? Oh, actually, they did really well this year. And getting those kind of insights without having to dump things in Excel or go through a million different menus, I think is actually it was very powerful.
That's awesome. Those two functions are definitely one of among our most used functions by users, by investors that are financial advisors or on Wall Street, and really kind of thinking about broadly what's going on from a factor perspective and what's going on from a trend perspective on this market scatter plot, which you could find under analytics, market scatter, and you could change whatever variables you want on top, as well as the universe that you're looking at. So that's awesome. Thanks for highlighting that. The last thing, kind of like before we sign off, let me kind of like stop sharing my screen. Or maybe, yep, there we go. And so I typically ask people for a movie or a show recommendation. This is a new year. Let's do something different. Is there any gadget or gift recommendation that you have for the folks watching?
Yes, there is. My favorite tech gadget in the world. I mean,
besides Koyfin.
Other than Koyfin and other than my everybody needs a meter. I have no affiliation to the company, nor do I get any commissions from them, but I should, because these little things are a game changer for food. You take this, you stick it in your fillet steak or your chicken or your fish or whatever you're cooking. It connects to your iPhone. You tell it what you're cooking. You tell it, do you like your steak rare, medium rare? whatever your preference is. And then every time it is cooked to perfection. It will tell you how many minutes are remaining. It will tell you how long to rest it for afterwards. Absolute game changer. So I cannot recommend a meter enough. It's spelled MEAT, like meat, and then a very, very great toy.
How much is it on Amazon?
Oh, I think they're about, in the UK, I think they're £79 or something like that. Okay. So I imagine that'll be a similar thing in dollars. Valentine's Day coming up. Great Valentine's Day gift.
For your partner, absolutely. And what are you kind of like, what temperature are we talking about when we're thinking about like steak for you? Is it your medium rare, medium?
It depends what it is. If it's fillet, I'm a rare guy. For anything else, I'm medium rare.
Wow, rare. Okay, cool. Awesome.
How about you?
I tend to go medium rare at home. I'll sometimes go rare at restaurants, but I'm a little scared at home for whatever reason, I think psychologically.
Yeah. Well, another toy you can get for that, which I have just got for Christmas and haven't tried yet, I'll be trying it tonight, is a sous vide. So you can get your steak to the right internal temperature over the course of a few hours, and then with the help of this and on the grill, just do the finishing touches. And in theory, that should make it even more tender. But I will report back after tonight's dinner.
I'm inviting myself over for dinner at some point. This sounds great.
Come visit London. Much wetter than Miami.
Cool. But sounds like the food situation is under control. Awesome. Well, Ross, thanks so much for kind of sharing those ideas and the outlook with us. Really interesting. And have a happy and healthy 2022. And talk to you soon.
Thanks, Rob. Been great back on, and keep up the great work with Koyfin.
Thanks. Bye.